disclaimer that says this is being recorded, and the next voice that you hear is going to be that. All right. Introducing the five C's of credit. Kevin and Isaac, take it away.
Okay, thank you very much. Appreciate it, Dr. Lewis. Thank you for the introduction. We do appreciate that. And also thank you to Dallas College for the invitation for the speaker series. Yes, so here, what's on your mind as a small business owner, or more importantly, what is always on your mind? As a small business owner, whether you're going into small business, you're currently in small business, or expanding, again, you have a lot of things that are weighing on your mind, such as your office space, inventory, market research. Just so much goes into prepping before you start. You're opening an office space or a retail space. You got to get insurance, right? Yeah, you got to start that for sure. Do you have an accountant, a CPA? Yeah, you need a lawyer. What type of lawyer? Again, these are things that are constantly evolving, changing, and it just depends on where you're at on the startup phase, existing or growth. A lot of these types of questions are going to be popping up, so keep that in mind. But most importantly, what ties this all together? What moves this, right? What keeps it going forward? And another thing, and this is completely all separate by itself, is what type of funding sources. So that's one more brick they're going to lay on to anything that's on your mind, right? Small business loans, right? So then from that point, again, what type of loan, or what should I get? Should I start with a line of credit? Should I start with actual cash funding? These are things that you're going to have to look at. Should I be conventional? Government loan programs, right? Government grant programs. There's a variety of them out there. Alternative lending, right? There's different types of lenders out there that do that. And in parentheses, we put UTB there. We consider ourselves an alternative lending because of our special loan programs that we have here. Am I going to use the credit cards? That's something big. A lot of small business owners have done that in the past, right? Where they started, you just bootstrap it. Of course, you got a lot of high interest rates, right? There's pros and cons to all of that. You also have crowdfunding, right? This is, again, really popular. A lot of people are actually using this to jumpstart their business. Also, giving away equity in your business, right? Selling ownership in your company. That's another thing, right? Or how much equity or how much ownership do you want to give away? It just depends. And again, as I mentioned before, self-funding, just using your savings account, selling what you can, and then, moving forward. So again, just with all those other things that I mentioned, and then funding sources, again, a lot of stuff is going to go through your mind. There's a lot of different directions, and hopefully we answer a lot of your questions here. If not, well, we'll definitely get those answers to you and get right back to you. But again, right? All right. Okay. So what lenders ask, thinking about that, what do I need to be prepared for when I'm talking to any type of lender, whether it's in the CDFI world, we'll dive more into that, or a bank, right? Or any type of lender of any sorts. How will the loan be paid back? That very, very important, right? From the business or the personal income. What will secure the loan? Most lenders require collateral. Again, just depending on the size of the loan, they're going to require some kind of collateral. Some programs do not, such as here at UTB, we have a special loan program that actually doesn't require that.
Yeah.
And of course, what other lenders are asking is, what is the risk, right? We definitely want to make sure that this isn't free money. We want you to succeed. However, giving you debt, we don't want to burden you with the debt as well. So again, what is the risk, right? What industry are you in? How risky is it? So again, things to think about. Will the business succeed? That's another thing that we always ask for. We definitely do. Are you a good borrower? That's definitely something we look at very in depth. Even if you're a startup, we actually look at your personal finances. We want to see, how are you paying back credit cards? How are you paying back other debts? That's how we measure it. It's all through history, right? And of course, again, what is your contribution? We want to see how much skin in the game you have, you know, so we think of that, we think in terms of liquidity, right? We will be looking at bank statements, things of that nature. Just want to see how much are you vested into the business? How much have you already funded your business? And of course, at some lenders, they actually have requirements anywhere from 10 to 20% liquidity in your bank account prior to getting a loan. Of course, good fortune, we actually have a loan program here that doesn't require that. So it's really good. So, and the most important question, it's really great. Would you lend to yourself? So think of it that way. You know, would you lend to yourself? And be honest with yourself. Don't say anything out loud, but definitely something we ask the an applicant for sure. So anyway,
Question before you
will-
go forward. I got a question
Yeah.
for you. You asked, would you lend to yourself? What are some obvious red flags that you see come in that people may not know are red flags, but they'd immediately put you on high alert?
we would look at slow pays. That would really worry us. Now, it wouldn't deny you, but we'd have questions or reservations. So we definitely look at slow pays. Any bankruptcies in the past, that's a definitely red flag. Now, again, it could have happened maybe 5-7 years ago. That's fine, but we're gonna look at past history for sure, and we definitely will look at in the present as far as slow pays, any debt outstanding. Oh, and definitely debt itself. So any personal debt that you currently have or an existing business, how much debt do you have? That's something that actually worries us for sure.
And then one thing that I'll add on top of that is basically one of the things that I also look for, especially to see if there's something that we can do a loan for certain, certain borrowers and things like that, is make sure you have your back office in place. We've had, borrowers in the past that don't have financials, they don't have their P&Ls ready, balance sheets or anything like that. And so when you go into a bank requesting a loan, that's basically the language that a banker and a person that's trying to, get some funding, that's like their language that they talk. They talk about numbers, right? Things of that nature. So just make sure you have all your back office stuff ready, because that's the way we communicate.
Yeah.
So that's just kind of what it is, something that, if somebody is not having that paperwork ready, it's definitely a red flag. Like, well, do you even know your business? Do you know your numbers? Or do you know if you're making money? What's your cost of goods sold? Things in that nature. That's one of the things that I look at when trying to lend some money to see if that's a good borrower or not. So that's another one that I just wanted to add.
Really, really great. Absolutely. Yeah. Just make sure, do not go to the bank, show up and just say, hey, I like a loan and I just want to see how much I qualify for.
Yeah.
Definitely red flag. Go ahead,
No
Dr. Lewis,
question.
you had.
This is okay, but I need a business loan. You said you're gonna look at my personal finances, but is my student debt and medical debt really gonna count against me? That has nothing to do with my business.
Yeah, actually, we wouldn't consider that unless it's default of some
So
sort.
we look at the global, right? So we want to make sure that we are going to get paid back our money. So one of the things that we look at as far as that is how much do you pay a month for your student loans? How much do you pay a month? Those are the only things that we really take into consideration, just so when we add our debt on top of that and what your income is and your profit, just to make sure that, okay, they can cover that debt plus some, if that makes sense. So we will look at it at that aspect. We just won't look at it, oh, you owe $50,000 in student debt there's no way we'll give you some money. We just want to make sure that you're still paying that debt, and then if we add ours on top of it, the income that you are making can cover that plus some, if that makes sense. So
The answer?
I have to ask this question. Someone wanted a definition. What is considered a slow pay?
A slow pay would be you missed the payment 30 to 60 days. You didn't pay on time. So yeah, 30, 60, 90 days
Yeah,
actually would
and
be
we'll get it
considered
more into that, cause we
Oh, yeah.
we have a slide that talks.
We
a
have
little bit
an
more about it.
example of what those types of slow pays look at.
Thank you. We'll hold the question. Thank you.
Yeah, great. All right. So again, put yourself in their shoes. That's how we look at it. All right, let's move on. All right, so yeah, this is it. This is actually what loan officers across the Dallas-Fort Worth area use. In some way, lenders have this in some way, shape, or form, right? But this is how they look at it. Again, we're looking at in other words, are you willing and able to pay back your loan? That's really what the 5 C's of credits are really focusing on. They're determining again your credit worthiness and are you ready for a loan? So again, at UTB and again, other lenders use this character. We'll dive into a little bit more of that, measuring reliability, capacity, right? Measures the ability. Do you have the ability to repay that loan with all your existing debt? Capital, right? Measures your commitment. That means, liquidity. What do you have? What currently do you have in your accounts? Collateral, what do you own? What could you put up for collateral when approaching a bank? And of course, conditions that could be environment or things of that nature where it's just measuring the timing of when you're launching your business or if you're expanding your business is the right time to expand. So yeah, we'll get into all 5 C's and take a deeper dive. So again, character. Yeah, it's not just a matter of like we'll meet you face to face, have a conversation, right? We figure out are you honest and reliable, right? But most importantly, how do we measure character? What's the only way to measure character? Well, we just look at your past experience, and of course, here in our society, how we function is with credit. And so again, we like to see if you have any late or irregular payment habits. We'll also look to see if you're building your credit. How are you building your credit? How much credit do you have? And what percentages of that credit are you using? That's really important. If you've got I don't know 50,000 in credit cards and you're at 49,000, yeah, that's a red flag. There's some trouble there. You got 50,000 line of credit cards and you're got maybe 3,000 in debt. That's responsible. That's that's you're using the credit cards in that way or responsibly. But again, it goes back to history. So we'll look at credit. We'll look at your credit score and to just get a better understanding of the repayment challenges and just looking at again, what are you missing? Most importantly, too, right here we have check for pending taxes or public legal issues. Really, really big. That's happened to us before, not just here, but in my experience in lending. We'll do an application and all of a sudden, I guess the person figures, oh, well, I have a tax lien. I didn't think you'd see it or something of that nature. So again, I can tell you something. If you owe the government money, you're not going to get anywhere. You got to figure that out. We do work with people that are repaying the IRS or government in any sorts with tax liens or anything. We do, but we do have to see a repayment schedule and show several months. It just can't be, hey, just started the last month. We're definitely going to probably see one a year for most part. 6 months to a year is really what lenders would like to see. And depending on the severity too, and the dollar amount. So it just really depends. But anyway, character, going back to, do we want to lend money to this person?
Quick question for you.
Sure.
All right, quick question. If I have my own business, but I'm married and my spouse has some character issues, he or she is not a part of that business, does that affect my ability to borrow?
No, that won't affect you. That should not affect you at all. If you're just a borrower, it's a separate entity. It should not affect you in any sort of ways.
Thank you.
Yeah, you're welcome. Okay, and moving on to the next C, capacity. Are you able to meet your personal and business monthly expenses and all other debt payments, credit cards and other loans? So again, exactly what we were talking about, with the school debt and the medical bills. again, you have 100,000 in medical bills, and then all of a sudden we're going to throw another 50,000 on top of that. We do not want the money to be a burden, and that's exactly what could take place, right? So just making sure that you have the capacity to pay back. So again, if so, you may have capacity to repay the loan, or we'll assess your capacity to repay a loan on looking at the bank statement. So we look at bank statements, tax returns, financial statements, balance sheets, income statements. I don't know if I said that already. But we look at all of that to really have an understanding. And most importantly, I could tell you right now, it's going to deal with cash flow. Whether it's on the business side or your personal side, it's cash flow. How much money do you have coming in, right? That's how we determine the capacity. All right, that makes it a big deal. Yeah, okay, we'll continue on. I think I'm missing anything here. Capital, what are you doing to support your business, right? That's, again, we can go, they kind of cross a little bit on that, but it does represent also savings, your time's involved, the money, the income source, all of that, the capital that you're putting into the business. We want to know what you have already invested into it, right? If you're a startup, things like that, well, lenders that work with startups, here at United Texas Bank, we only work with businesses that have been in business for 2+ years. Now, we have a special loan program. We can make some omittances, right? We have done that in the past. An example, we actually worked with, technically it was a startup because he was less than 2 years, and he owned a drywall company. However, he had owned a second company that had been in business for already 7 years. It was a plumbing company. And so that one company was a guarantor on that startup. And of course, the company that had been open for 7 years had a real strong cash flow. And it had positive numbers. And so we were able to work with somebody who owned a company that was less than 2 years. Just giving you an example. Banks normally don't do that. But again, we have a special loan program that actually takes care of that. So not trying to get sidetracked, but capital, right? Being a big deal. So again, capital, you might want to think about this too if you're a startup. You look around, you might think, hey, I don't own anything. Hey, some of these other organizations, I won't take a deep dive into it, but CDFIs, those are community development financial institutions. These organizations, they work with a lot of startups. I myself have worked in that environment for many years. And so I do know a lot of people in that industry, and I know the industry very well. They'll use your desk at home, a desk, chair, your laptop, that'll be considered collateral. So unlike a bank, we're looking for more bigger items, things like that. So don't count yourself out. You do own something, you do have something. Actually, the other CDFI I was working at, there were people would use their cars, really. If the car was paid off, they can actually use the car for that. And again, those are CDFIs that work with that specialty. So that's something to think about as well if you're needing cash to jumpstart the business. And it's a legitimate lender. CDFIs are legitimate. They're back with the they're certified through the Treasury, and so that's the only type of lending I would recommend outside of a bank. There are other options, there are other things that are going on, but again, I don't recommend that those types of lenders. But the CDFIs are very credible.
Yeah, especially if you're starting for a business. CDFIs do work with businesses or new entrepreneurs.
Yeah.
And they do lending with them, and they'll work with you, they'll talk to you. So yeah, we definitely highly recommend a CDFI.
Yeah.
If you are looking to fund, your business, or looking for in general.
Yeah.
Funding. Yeah.
And again, collateral kind of mixes with capital, right? But we definitely here at the bank, we definitely want to see what you can pledge. What's a second source of income, for sure, or repayment. Again, the collateral is just another way of guaranteeing that we will get repaid. And so that's the important thing. We want to see, you know, if something happens, what can we collect? So again, going back, as I mentioned before, collateral being a big deal. So I'm gonna move on from this because again, that kind of crisscrossed. Conditions, you know, what do you plan for using the loan for, right? Do you know your market? What conditions might affect you on the use and repayment of the loan? Again, startups require a business plan for sure, right? But conditions, I want to say like, it could be for startups. I guess a great example would be, COVID, right? A lot of businesses, right? Not a lot of lending going on. Those conditions, a lot of banks were retracting the loans, right? CDFIs work with startups. Not a lot of startups was going on. We had a lot of the PPP loans, right? Those emergency fundings. So conditions, what not, you know, not, it talks a lot about the environment that you're in, right? Okay, you're a snow cone shop, you do ice or ice cream, and you want to open right in the middle of January or December here in Dallas. Probably not a good idea, right? We want to start a little bit more on the warmer weathers, right? What does the economic environment look like? So again, those are things that a lender will definitely look at, and based on your industry as well. So yeah, those are things that consider, especially when you're looking for funding. And
I believe that's all as far as for 5 Cs of credit is concerned. That's mainly the biggest 5 Cs that there is. I don't know if there's any questions. We can pause real quick.
yeah, we can pause real quick before we go into credit reports and what we look at and more in depth. But any questions on the 5 Cs of credit?
All right, this is
Dr.
your
Lewis?
chance, guys. We'll pause for you to put some things in the chat if you would like. Because I'm pretty sure you have a question or two about a few of those. I'll give it a
If
couple
not,
seconds. I don't see anything yet.
Okay,
All
well,
right.
well, here we're gonna start with the credit report, and I'm pretty sure we're gonna
Yeah,
have a
this
lot
is
of
where it
questions.
gets really interesting. This is where a lot of people really get their questions in. But yeah, so Isaac just mentioned the 5 Cs of credit. One of the things that I did want to mention and add on here is credit reports. You know, I kind of like to consider it a 6C, right? Once you go through the 5 Cs of credit and the lender's asking you all these questions and you're answering them right, and it looks like, okay, well, this is potentially could be a good borrower, and we could probably work with their business and providing them a loan of some sort. Well, obviously the next step is, all right, well, let's start looking at their credit and seeing, you know, what they've done in the past, and seeing, you know, if that's something that we want to, you know, actually invest in their company with a potential loan. So pulling a credit report, you know, bank looks at multiple things in a credit report for potential borrower. Obviously, the number one thing they look at first thing is credit scores. All right, well, let's see if this person can pay me. What's the likelihood of this certain borrower it's gonna pay me back? So that's the first thing we look at, right? Credit scores. Now, I don't want everybody to get discouraged with credit scores, because I understand, you know, it consists of a lot of things, and I'll kind of go through that here in a bit of what it consists of. But, you know, I mean, as long as there's like a story, and hey, so this is what's been going on in the past, this is what I've been doing to work with it and stuff, you know, they can be banks that will work with you. I mean, Isaac keeps mentioning our special loan program that we have here at the bank. We actually don't require, there's not like a certain credit score that you have to have in order for you to get a loan. I mean, there's other financial institutions that you have to have like, what, 650 or 750 or something.
I can tell you right now, with CDFIs, if you have a 640 and below, you're automatically declined. With a bank, it's 680. I think it went to 700 recently with the banks, actually. It was automatically, you apply, it's declined. But again, like Kevin was mentioning, our special loan program, we don't have that.
Yeah, we don't have like a set credit score. We'll look at it. That's the first thing we're gonna look at. And then as long as you could tell us, you know, what was going on, if there's a story, and you know, obviously it makes sense, when we can, you know, definitely bypass that. But that's the first thing we look at though when we pull your credit report, is your credit score. After that, it's like your accounts. It's like how many debt do you have? How many do you have? Credit cards? Do you have a car payment? Do you have a mortgage? We'll look at all different aspects of what you have under your credit. You know, we look at late payments, the third biggest thing, you know. I mean, if you have so many late payments, yeah, it's gonna be very tough to get a loan because what's the likelihood of you paying me back, right? So that's one of the things we look at. We look at past dues on your credit report, any collections or charge-offs that you have on your credit report. We'll look at that more into detail. And then obviously bankruptcy, it's one of the, also the things that we look at. You know, it stays on your credit report for, well, it stays on your credit report for 7 years, but can potentially stay longer. Doesn't mean that necessarily after 7 years, a bank looks at that and just denies you. They'll probably just look at that and see what happened. And it's like I said, it all just depends on the story. And seeing exactly what happened, a banker can look at past those things. So, well, that's one of the kind of few things, and I'll go more into detail on each one here in a bit. But as far as like kind of like after the 5 C's, I like to include credit reports. That's the next biggest thing that us as bankers and you know people that are underwriting your loans look at. So, what is a credit? You know, comprised of, and it's comprised of a bunch of stuff, but the majority is here. So the biggest thing is payment history, right? Reported payments. 35% of your credit score is have you paid on time or have you paid late? So if you've been making a lot of late payments, it affects 35% of your credit score. So that's one of the things that you want to look at, that when you are you know, getting into debt and when it comes down to actually paying back that debt, make sure you always pay it on time. Because it does affect 35% of your credit score. 30% of your credit score is how much of your credit is in use. That's why they usually, and you've probably heard this in the past, you know, 30% is like, you know, the rule of thumb. Like let's say if you have $1,000 credit line, you only to only try to use no more than 30% because, you know, a bank can look at those things negatively in the aspect of, all right, you used up all this, you know, your credit for this credit card, right? Oh, well, I gotta open another one, right? You open another one and then you use all that credit on that credit card. And then at that point, the next bank's gonna be like, well, you just opened this credit card, used it all. You just opened this credit card, used it all. And they can start looking at those things negatively. So if you have a lot of, you know, just try to use about 30% of the credit that you have. It's kind of like the rule of thumb. The next thing is 15% is, you know, how long have you had your credit? Obviously, and then 10% of that is new credit account. So 10%, what that means is, let's say if you open or you try to apply for a loan at this bank, right? And then the next week you try to open a loan at this other bank, and then you try to get another loan at a different bank. Within the first month, you've had like 5 credit or trying to open 5 different type of credit accounts. A bank can look at that also negatively because you're trying to get a lot of debt. And so they can look at that kind of like desperate mode in that point, and it could affect your credit score negatively at that point. And then obviously 10% is a variety of credit accounts. So it could be like, you know, do you have a mortgage, a car payment? How many credit cards do you have? A variety of all that affects 10% of your credit score. But obviously 100% of all that is worth your to monitor. Make sure you always, you know, look at your credit scores. I think you've probably heard of people use Credit Karma and things like that. You know, I highly recommend it. Just keep looking into your credit scores. There's 3 major credit bureaus, right? And I don't know if it's on the next slide. But anyways, Equifax, Experian, and TransUnion are 3 main ones. Each one of those does provide a free credit report every 12 months. So you are able to go to the website to each one of those and pull your credit report for free every 12 months. One of the things that I like to tell people is those 3 credit bureaus, they don't talk to each other at all, right? You know, depending on what type of credit that you receive. For example, here at United Texas Bank, we only pull 2, right? We only report to 2, Equifax and Experian. We don't report to TransUnion. So that's one of the things you got to look at. Not every bank or any financial institution or credit cards report to all 3. Some of them may just report to 1, some report to 2. So it's always good to pull all 3 because all 3, that's why there's always 3 different credit scores. So that's kind of one of the things that, you know, looking at credit scores here, right? 2 major credit bureaus like Equifax, we pull. TransUnion also pull with us. It's only if you're doing a mortgage. That's when we pull that 3rd one. But typically we only do 2. So what is a credit score? Like I said, it predicts how likely you are to pay back a loan on time. I mean, it's kind of like, you know, a way for, if I've never known Isaac, right? And he asked me, hey, can I borrow $500? I'm just not going to give a stranger $500. without me knowing his history or what has he paid other people back if I let him borrow his money. That's basically the best way you can look at what a credit score is, right? 300 means bad, 850 is excellent, right? So that's basically what the meaning of credit scores is. And the reason banks look at that. Let me talk a little bit more about the credit accounts, and when we pull a credit report, the three things that, we look at as far as your accounts. The first one being real estate, right? That's kind of like your mortgages. If you own a commercial property, you're trying to open a business, right? You own that commercial property, it's considered real estate, any industrial land, things in that nature. It's all, it's under the real estate account, part of it, and I'll show you here how it looks like. Installment is all your term loans, right? So like you have a car loan, personal loans, anything that you are to pay a certain amount each month after 3-4 years to pay off that debt. That's what it's an installment loan is considered. And then you have your revolving accounts, or your credit cards, revolving lines of credit, things in that nature, where you use it, right? You pay it down, and then you still have that credit card or credit to use for something different. And so typically those are your revolving. It's supposed to be like you use it, you pay it off, and then you use it, you pay it off, things like that. So it's kind of the best way to look at that. And other items that could come up on your credit report, like medical bills, cell phone bills, utilities, things like that, could pop up. Technically, they're not supposed to be there. So if you do pull your credit report and you see things like that like a medical bill is reported on your credit report, cell phone bills, you could dispute those because they're not supposed to be there. So something to keep in mind. Because a lot of people don't really know that. They think it's supposed to be there, but it's not. It's not supposed to be reported to
And
your
keep
credit
in
cards.
mind too, that we look at any of the business owners, whether it's 50-50 or whatever percentage, we'll look at both business owners when determining that as well. So keep that in mind.
Quick
Sorry to
question,
interrupt.
2 questions for you. The first question was, well, first off, I learned something because not that I've had this issue, but I didn't know that cell phones could not be listed on a credit account.
Yeah, they're
and
not supposed to. So you
Okay.
should be, if
I
you
just
go
had a
to your credit
flashback
report
to-
and report that, you should be able to dispute it.
Okay, gotcha. I had a flashback to being in another country and my data went all the way up, and boy, I got a pretty nice hefty bill when I got back, but I paid it off. So had I known, I still would have paid it, just joking. So then someone asked a question, can you talk a little bit more about exactly what a charge off is? What is a charge off?
A charge off is basically like, let's say you weren't able to pay that on that debt or for X amount of reasons, it goes to collection. A bank has to charge it off, right? Somebody else is gonna buy that debt from us, and we at least recover something off of it, and it's just charged off, but it stays on your credit report as a negative impact.
Yeah, so it's something you just default at the credit cards, cars, anything, a mortgage, you can
Yeah.
walk away from it. That's
That's
the
considered
bank will
charge-off.
they consider that as a charge off, yeah.
And then that's when a collection agency or something buys that charge off.
I think it's
And-
after 6 months. I think a bank or financial institutions try for 6 months to get that loan back, and they try to put you on repayments. There's different programs that financial institutions will try to do before sending that credit, selling the credit off. But after 6 months, they'll sell it off,
Yeah.
and then it's with somebody else, and then that's it. We sold it, but we charge it off, and it goes on your
Yeah, and
credit.
it goes on your credit as a very big impact. It'll affect it really pretty
Yeah.
significantly, so.
Big time.
And then was there another question, or
Another
was that the
question?
only one?
One more question for you. So you mentioned credit score. This looks like personal credit score. Can you talk any about a DMV credit score?
A DMV credit score.
Yeah,
Duns and
following
The
Duns and
Brad-
Bradstreet.
Yep.
Yeah, no. Or like a BK score, that's a business one.
Yeah.
No, we're gonna go by the guarantor. We're gonna go by a credit score of the business owner, a physical person. I've come across that here and there. Some business owners, well, I got bad credit, but I'm putting it in my company's name.
Yeah,
And they want to dispute that and kind of don't understand. Yeah, you are the business, bottom line.
yeah,
End of story.
yeah. We don't do small businesses loans as far as just for under the small business. We only do it if you're gonna be personally guaranteed on the loan. And so we've never really pulled credit reports on businesses. It's only on you personally, so.
And actually, you need to report that. If you've been paying well on time, Dun and Bradstreet, you actually report that to Brad and Dunn Street. You'll actually do that. I know at the CDFI that I was at, believe it or not, we never, nobody does on that. They never report it directly. So we would always tell the customer, hey, after you've paid your loan, whether it's 3 years, 4 years, 5 years, don't forget, you need to report that into the, to Dun and Bradstreet, so they can actually show it as a business loan. Because those were more consumer loans in some ways,
Exactly.
but they were business.
And then just kind of moving forward real quick, just wrapping up credit report bureaus. These are their information. So if you want, and they'll give you obviously these slides with this info, but if you want to take a picture or screenshot real quick, this is basically their contact info, phone numbers. Like I said, you are entitled to a free credit report for each one of these every 12 months. So please take advantage of that. Or unless if you already have Credit Karma and stuff, they do soft hits, but it's always good to go with them directly because they don't always report everything. So just FYI, I like to include this slide just to kind of give you that information in case you needed it. So, but anyway, so I'll go ahead and keep moving forward. This is kind of an example of what a credit report looks like, right? So just to kind of give you a quick, so you can kind of see like, for example, we look at your account tabs, kind of what I mentioned earlier. So there's like real estate, installment, and revolving. So that's the major three. Real estate, this person, for example, has one, right? And it has a balance of 250,000. That's more likely like a mortgage. They more likely have, a house or something that they're paying on. So, but if you look across, right, the current close, and then 30, 60, 90-day late, that means that this person has been paying their mortgage, without no problem, which is perfect, right? Then we have installment, for example, with this example, which obviously that could be like your, car loans, personal loans, things in that nature. This person has 45,000. Well, they already have 8,437 past dues. You see how it's in red? That's already notifying us, hey, this person's not doing good with, their installment loans. That means that they're either not been paying it, they've been paying late, and that's where the past dues looks like. And then it'll show like the number of days that, there's an $8,000 past due, and it's been over 60 days that they still haven't paid it. So you can kind of start seeing that on the report. Same thing with the revolving, that can be your credit cards and things in that nature. This person has 7 credit cards, for example. At balance, total balance of 7,850. There's maybe one or two of those credit cards are past dues, and there 2 of them are past dues 30 days. So this is just an example of what we look at when we're looking at your credit history.
Remember, somebody had a question about that, the past dues and what they look at. And this is what comes.
Yeah. So when we pull a credit report, we want to see just the black numbers, and that's it.
Yeah.
If we start seeing red, as you can start seeing that's bad. That means that there's something going on with your credit, and maybe you might not be a good potential borrower to lend money to. So this is just kind of an example that I wanted to show you guys of how exactly that looks like.
Yeah.
But anyways, that's basically the credit
And the
report.
delinquencies there, right? We talked about this, right?
Yeah.
So just to clarify, because there was a question in the chat, and I know you kind of spoke to it earlier, that different people use different companies use different things. So someone asked, I've seen different credit scores from different sites such as Vantage, FICO Score, 389, etc. What score do lenders actually use? And I'm going to add on to that and say, you gave us some numbers earlier about what was considered to be a good score, but sometimes the credit score actually goes all the way up to 900 versus just 850. Can you shed some light on that?
Well, as far as what would be a good score, like somebody to lend to?
No, it's just that technically the best is 850.
50.
But there's some
650,
that
yeah.
have 880 and things in that nature.
Yeah, it would, I mean, we're working with somebody right now, a company, the business owner, the credit score was at 629, 640, on the different ones. So, yeah, I mean, and other banks, I think, well, again, like I said, some banks at 680 will cut you right off. It just depends on the bank and the lender, what kind of appetite, what is your business? What type of industry? Believe it or not, not all banks that do small business loans or business loans in general want to go after the same industry. So it depends really your industry and what bank you go to. And so they'll determine, right? What's a good credit score? Oh, we really like that business. Yeah, we're going to be a little more flexible on that credit score. So it really depends, right? Now, okay, what's the worst one? If you see a 550, 500, yeah, it's pretty bad. Like, you're not going anywhere at all. So I guess it's safe to say, I guess anything below 600, but you know, again, yeah, you're pretty much done under 600. So that'll give you a better idea of where you don't really want to be. That answer the question?
I think so. I think people are just trying to figure out where they can get in, because there's so many things out there. It's like, which
Yeah.
of these am I supposed to go off of? I mean, is it, because everybody's got a different angle. They want to give you different information. I will ask one more question before you go into the different loan types. If I wanted to focus on one or two things that would really make an impact on increasing my credit score, which one of those things should I focus on first?
Well, I think the slow pays, if you want to get real, I mean, I think the slow pays, any delinquencies of any sort on your cable, on anything, phone, whatever it is, you don't want any slow pays popping up. You want to show that you're just responsible. I would focus on that basic. Also, go ahead.
But I was gonna say, one of the things that I will look at to try to improve credit, let's say if you have, you know, a few credit cards out there that are maybe max or something, or I would start paying down the ones with the higher interest rates would be the first thing that I would do.
Yeah.
So like anything that has like maybe a 20, 30, 40% interest rates, pay those down immediately. Those would impact your credit score pretty heavily. And then try to start using other things that you can, like, you know, maybe improve your credit. Like people that I've heard have used Change, which I think people, you know, I don't know if you've either heard of them or not, but they're basically a way where you can basically put money into an account. It's kind of like a savings account each month. And they report it to the credit bureaus as a payment, quote unquote. And then after the end of the term, it could be 12 months, 24 months or whatever, you get all that money back. And then, but they've reported to the three major credit bureaus, you've been making your payments on time, and that also helps you boost your credit scores. There's many different ways you can do that, but the first thing I would focus on is pay down the ones with the higher interest rates. That would be the best thing to do to
Yeah.
kind of start increasing that credit score.
Yeah, for sure.
All right, well, let you keep going and talk to us about loan.
All right, different loan types, and I'm only really gonna talk about two because I'm talking, obviously, we're kind of on the subject of entrepreneurs and small business. And these are the major two that you can find anywhere in any bank, not just like, for example, us, or if you go to CDFIs or anything. There's different loan types, obviously, that you can do. It all depends on your business, what you're looking for. Because you don't want to get a certain loan, but you're trying to do something different, and then now you're stuck with a huge loan with a huge interest rate for no reason. But one of the major two that I want to talk about today is the first one is business line of credit, right? The line of credit, it's kind of like, the best way I can explain it is like a credit card, right? For a business, you can be approved, let's say, for 50,000, right? And if you're kind of using that money to like maybe short-term things that you need to pay now before you get paid, and you can pay it off. So for example, let's say if I work at a roofing company, right? But I need to pay my employees first, right? I need to buy the material out of my pocket. I need to pay the employees, things of that nature. And then once I'm done with the service, then I get paid back from the individual that maybe I did the roofing for. Then I can use that money to pay the loan, the money that I used on that line of credit off, and then whatever is left is my profit, right? So a business line of credit can be used for that reason. You won't, if you could be approved up to 50,000, that doesn't mean you're gonna get $50,000 in your bank or anything. You only use it as you need it, right? So let's say you got approved for 50K, and then, okay, but I need 10K for this project I'm working for. You'll contact the bank, and then they'll send you 10K of the money you need. You use it for whatever you need, and then once you get paid back, you're gonna use that money that you got paid back to pay off that line of credit. It's supposed to be kind of like a hump. We call it like that. You're supposed to use it, let it sit for a little bit because you're obviously using it, and then once you get paid, you pay it all the way down. That's what a line of credit is used for. A lot of people kind of get these confused because they think that you could just run it up and then it just stays up. And when a bank looks at that, when it's time for renewal, they'll probably look at that and be like, well, you're only using it up, you're not really using it down or anything, and they're just gonna term it out. That means you just lost the line of credit you could be using every single year, and then now they just termed it out, where you just pay us
They converted to a loan.
to a term loan, and then you just pay it off in 3 or 4 years, and it's done, and you're done with the loan.
Yeah.
So It just depends on what you're looking for. So if it's like for paying short-term expenses like payroll, maybe there's a couple of things, expenses that you need to pay right now in the meantime before you get paid from other services that you've provided. Things like that, kind of like what I explained with the roofing or any construction sites that, you know, you need the money now before they pay you, and then once you get paid, you just pay off the loan. That's what a line of credit is used for.
And that
Right.
goes back to red flags, by the way. So if you keep that balance high on those lines of credit, yeah, there's a red flag. You're in some kind of trouble. We don't know what kind it is, but you are in trouble. So
Yeah.
just keep that in mind.
And there's an example of how it should look like when you're using a line of credit, right? This, for the example, this person used it in December, let it sit for 30 days, and they paid us all the way back down at the end of January, and then used it again in February. This is how it's supposed to be. You're supposed to use it, you know, you obviously are using it, and then you pay it down when you get paid. That's how it should look like when it's time for the renewal on that loan. The bank, whoever's approving that loan, it's gonna look at this, okay, they're using it how they're supposed to, and it's like no questions asked, they'll approve it, and you can keep using it for the following year. Usually, typically, these loans are only 12 months. And then you typically only pay interest on those loans each month. But like I said, it's not like you just pay interest each month and you're good. Those typically, you just pay the interest each month, but then when you get paid, then you pay all the way down, if that makes sense. That's what a line of credit is used for. Depending on the type of business you may be using, this could be a type of loan you're looking for. Now, let's say if you're using, or if you're a construction company that needs like really big equipment, maybe, or if you're at, you know, an industrial that needs a certain type of machinery, that you need, like, you know, to pay that, then that will be considered a term loan, right? So a term loan, it can be used to use like for big equipment. Maybe you need a term loan to buy property, real estate, you know, maybe you have a pet store and you're trying to buy a building, and you're trying to buy the whole building and property, then that's, you know, that's considered a term loan. Inventory, things like that. Those are term loans. Term loans are typically, they range from 12 months all the way up to 60 months. And it just means that, you know, for example, if I'm buying an equipment for my construction company, right? If the vehicle's worth 40K, for example, then they'll just kind of spread out the payments, principal and interest payments each month. So after, you know, 60 months, you pay off that debt. So those are what's considered a term loan. Those are the two major ones that that mostly all banks offer. It just depends on what you need it for. If you need something short term, to pay something short term, and then you'll pay us back once you get paid, then probably a line of credit is the best option for you. But if you're using something for like, you know, a big asset or equipment or, you know, inventory, things like that, that you want to pay monthly principal and just kind of like a car loan, right? And then once you're done with that term, then you paid off that debt, then probably the term loans are the best option for you. But those are the two different types of loans that you should be able to find anywhere. And it just depends on what you're using it for.
That's right. And again, the rates will be different for a line of credit or a term loan as well. So, but again, all banks are different. And so, yeah, you have to check with them as far as rates, things like that.
Yeah.
That's it. That's the last slide, right?
That's the last slide. That's all we really have for you as far as, you know, vibes of credit, what banks look at before they try to do a loan, and then kind of then look at credit scores and then just the different types of loans. So that's all we really have for you today.
Any questions? Anything else? Dr. Lewis?
I'm gonna let folks come off mute in just a second, especially Kelly, because she's got a question. And I want to make sure I can get it right. But Dennis asked, how much will your credit score affect your interest rate? Like, how do those correlate?
Well, obviously, the lower the interest rate or the lower the credit score, the higher the risk for a bank. So in order to protect the risk, they'll probably offer a higher interest rate.
Yeah.
So, and then obviously the higher the interest rate or the higher the credit score, I'm sorry, the lower the interest rate, because, you know, we can see that you paid people in the back and your history shows that you've paid without no issues, then you can pay us back and the risk is low. And so the interest rate is usually low.
Yeah.
And it just depends on, like I said, if you're looking for something personal like credit card or like a car loan or personal loans, those usually go based off of credit score. For a business, the only way that they'll increase your credit score, obviously if your credit score is low, they'll increase it depending on whatever prime is, and they'll either tag on 1% or 2 or 3.
Yeah.
It just depends on, and that's where a bank looks at credit scores in that nature, but most of the time, if it's pretty, average, then they usually do prime plus 1%,
And
and
it's
that's your
usually
credit score.
prime +6 anywhere, or 1 through 6. It could be more, but it's still 1 through 6 is typical. But it's prime plus.
Yeah.
So don't forget that. So it's based on the Federal Reserve. Right now, it's at
Yeah.
8%, and the bank tags on its rate.
Yeah.
Hopefully that answered the question.
All right, so I've allowed you guys to unmute yourselves if you have a question. Now, obviously, if there's something that's super specific to your business, you may want to hold that one for after this is still being recorded. But we want you to be able to ask Kelly, if you don't mind unmuting yourself, I do want you to be able to ask the question for clarification that you wanted.
Okay, I heard, I'm sorry, I don't remember your name, the speaker, when you talked about that, did you call it change? Where it
Yeah.
looks like you're making a payment or something like that?
Yeah.
Okay, cool, thank you.
Mhm.
Right. All right, so Kelly was bold. She came off mute and asked her question. Thank you for going back on mute, Kelly. But what other questions do you guys possibly have? That you want to get answered? We've got two experts who their job is to give away money, but responsibly. So what questions do you have about how you can get funding for your small business? While they're thinking, I'll ask a question. How long should I realistically have to be in business before I can start seeking funding?
2 years.
Is there a limit?
Usually it's 2 years. That's usually the rule of thumb. I mean, if usually any business that fails usually happens within the first 2 years.
Yeah, for the first 2 years.
After 2 years, that means the business could be stable, and then a bank will start looking at maybe potentially funding because they see success now with the 2-year history. So 2 years is usually
That's the typical.
That's the typical.
With CDFIs, a startup to them is considered 6 months. So in month 7, you're not considered a startup to them. But that's in the CDFI world with those types of startups. But with us, yeah, all banks, for-profit lenders, it's 2 years.
Okay. So another question for you guys. Is there realistically an advantage or is it a disadvantage if I have my personal checking and savings account at your branch?
That's definitely an advantage.
Yeah.
We actually, if you were planning on doing a small business loans with us, we do require, you have to open a small business checking with that loan.
Yeah.
But it is definitely a big plus to have your business, your full business here. at the bank.
And yeah, your personal accounts, but it's just to see how you're using your accounts responsibly. That's why we do that. That's how we build the relationship. So it's through your accounts.
So if my credit score isn't the greatest, not saying it's a 550, but maybe it's in the mid 600s, but you've seen money going in my account, pretty steadily, and there's a balance there. How much does that play into affecting your decision?
Well, it's determining cash flow. We're not gonna just, we don't base it on just one thing. So it's a combination of a variety of things, right? Your tax returns, your balance sheet, your income statement. We get a snapshot, right, of where you're at in the moment. And then we look at your accounts as well. How are those accounts holding up? So it's a combination. But as long as you're cash flowing, right, you got money coming in, that's what will determine. That's what will determine whether you get not a dollar amount, but a certain dollar amount, right? It could be maybe 20,000, 25,000, 15,000. That's where that plays into it. Yeah, you qualify, but maybe not for so much. So.
Okay. Well, I think they've answered most of my questions, so I'm gonna turn it back over. Is anyone on the line want to put a message in the chat? I'll be happy to read it. Or is there anyone who wants to come off mute and ask their specific question? I have one more question I just thought of. Right now, what are some of the industries that your particular lending institution or just the banking industry in general is excited about funding and lending money to?
Yeah, well, that would be, well, we'd have a long list. I think it would be safe to for, how about we just say which ones we wouldn't do business with? Anything for adult focus only type businesses. And then,
We wouldn't do restaurants here.
restaurants, baked goods, things of that nature. Banks, lenders don't normally go to that direction. However, CDFIs will work with restaurants and bakeries, baked goods, any perishable items. CDFIs will work for with small business owners. They and the CDFIs also will not work with any adult focus type businesses. So that sums that up. Now, it depends on the bank and the lender. There might be some, businesses that's not their appetite. Oh, I don't like the trucking business. Some banks will say we don't deal with any trucking or transportation. Some banks, maybe larger banks, might say, oh, we do work with trucking, but you have to be 5 years in business. Okay, so it all depends. It's all a variety. You got these community banks, you got regional banks, and you got the national banks. And so it's all a mix there. So it's quite a bit. And you got to do the research. You got to have those conversations. Come in and talk to Isaac. Hey, what do you think about this industry? And look at it. But you're going to have to talk to several banks and have those conversations. Yeah, it's a long journey before starting a business, or you have your business, you're up and running. You got to have those conversations with a variety of banks and take time to do it, and just be cautious and careful.
So I'm pretty sure I know the answer to this one. It is off topic, but if I didn't ask, I wouldn't be doing our audience a service. So someone asked, do you also do mortgage refinance loans? And maybe not in your department, but your institution.
Mortgage, no.
We don't have.
We don't do mortgage loans here. No, yeah, they were saying, do we do mortgage like financing? We don't do, sadly, we don't do mortgage because mortgages here. The reason why is because we're kind of more of a commercial bank, so we only do 3 main type of loans. If it's a commercial real estate, so if you're buying a pretty big building somewhere, then they'll look at those. We do construction loans. So if you're like a builder that builds, 10, 20 homes, and at a certain area, we'll do those loans, and then obviously any type of small business loans.
Yeah, we'll do our special program is what small business. So yeah, we'll do that.
So those are the main 3 that we kind of focus here at this bank. But like if you're trying to buy a house or a mortgage, we don't,
Or
sadly
auto,
don't do those here.
we don't have those
We don't
products.
do, yeah.
We don't have those products.
I'm sure this is going to come up because you mentioned you do commercial real estate, you do construction, and you have special programs. I think I heard you say, Isaac, for small businesses. Obviously, we're just kind of want to get an idea of what do you mean by a special program? What does that entail? Is that something different than somebody walking in off the street, or why is it a special program? Tell me a little bit.
Well, our special program, it's a special small business loan program, and we're very proud of it because I can tell you right now, I've spoken with a lot of bankers, a lot of banks. When I kind of do different types of presentations, there's bankers online that say, wow, our bank really doesn't have a designated focus on that. And so our special loan program is focused on women entrepreneurs, minority, and low moderate income areas only. And we have special pricing. We have an application that's only $100. Typical applications, they're $1,000.
Yeah.
And on CDFIs and other lenders, they'll add 1%, 1 to 2% of the loan amount you borrowed, and they'll tag it on at the end of the loan. But you just pay $100 with us.
Yeah, so like for example, on that program for how you guys I had mentioned earlier about our lines of credit, our pricing for those are usually just prime plus zero. So we don't even tag on any percentage, whatever the Fed has it, the rate. We usually that's what you'll get. The only one that we do tag along a rate is these term loans. These term loans, we either do prime plus 1%, or if the rate's high, we'll do a treasury rate. Depending on the term of the loan, it could be a 2, 3, 4, or 5 year. We'll do like a 2-year treasury, and then we'll tag on like usually 3.5%.
3.5%. So it'll be less than.
It'll be less than whatever prime is offering.
Yeah.
So we're just trying to give you the better rate.
Oh yeah, we don't require secured, so they're unsecured as well. Remember we were talking about collateral? Well, it's unsecured, again, unheard of. So that's a special loan program right there for sure, right off the bat.
Mhm.
And the deposits, losing my train of thought. Usually banks, CDFIs will require 10 to 20% liquidity. We don't have that here with us at this special loan program. We won't require that liquidity. However, I'm gonna put a little asterisk there. Yes, it depends how your business is doing. Is there cash flow? Is there something else there that can alleviate that? But right off the bat, we won't require you to have that specific dollar amount. So yeah, that's another great, a special item that we have with our special loan program. So it's really great.
Well, I'm sure people are gonna have some questions about that program that obviously I can't answer, and you guys have been great about giving us really, broad scale information. So I'm gonna steal your screen for just a quick moment. And I'm sure there may be one or two more questions that somebody's gonna want to ask. But is it okay if when I send out the thank yous and the follow-up emails that I include the website to your bank or contact information, just in case people have they want to make an appointment? What would be the best thing to give them in case people have specific questions about making an appointment to come in and see about their fitness for a loan?
Well, yeah, contact me directly. Can I put that in the chat or something? Or did
Yeah,
you?
So it's on the slides.
Yeah.
It's on the slides with our contact
Yeah.
info. It has his email, it has his phone number.
Phone
everything.
number and email. Give me a call. We can definitely have a conversation, or come down to the bank and we can meet. I'm always open.
I would say this, if you don't mind dropping it in the chat. The reason I say that is because I have to wait on Zoom to do the recording and put everything together. So that's a day or two. Somebody might be super excited and want to come make an appointment tomorrow. Not that you aren't
Yeah.
probably booked up, but knock yourself out and put it in the chat. Go ahead.
I have a question real quick. I'm so sorry. Is Kelly still on the chat? Is she still on here?
Kelly is still on here. Yes.
Okay, I want to apologize to Kelly and everybody. It wasn't changed. I was thinking about something totally different. It's called the Self app. I apologize.
Self.
SELF. Yeah, the Self app is the one that can help you increase your credit by depositing money into a certain account depending on the term, and then you'll get that money back, but they'll report it to all three major credit bureaus. It's called the Self app. I apologize. I was thinking about changing. I was thinking about something totally different.
Can you put that in the chat? Cause I don't know that I can spell that. And so if you don't mind putting it in the chat, I think
Of
that
course.
would be great. That way, Kelly, thanks for hanging on. Glad we got that updated information for you. SEL FAT or something of that nature. He's gonna put that in the chat for you. And then I have already stolen your screen. So I'm gonna actually come off camera and give you guys some time to hop off camera so that we don't see you trying to pick and spell out self-fan as well. But I just want to tell you guys, thank you so much again for joining us. I know some of you guys came in late. Don't worry. We do still have our AI companion that's taking a summary, transcribing all the information, making sure you know what's going on. But I would be remiss if I did not finish this out with just a couple other things. I told you in the beginning that this is just one of 5 presentations that we're doing for entrepreneurs that this fall, we do this every spring, sometimes in the summer, every fall, and we do different things, or we bring back great things because we want you to hear about them. So this is the second of 5. If you didn't come a week and a half ago, you missed out on marketing in the age of AI. That one was unreal. And I say that not just joking, but it was pretty darn awesome to see exactly, what could be done and what you can do through AI. Tonight, you learned about the 5 C's of credit. Again, that was awesome, but I've got to tell you about what's coming up next. And that is for anybody who is in the food and beverage industry. We've got an in-person or online. So we will meet you whether you can come and join us and have free dinner on us, or you can join us online on Wednesday, November the 6th, 5:30 p.m. at the Dallas College campus off Webb Chapel. You do have to register so we can make sure we've got enough food. But Cameron Burkhart from Sugar Beet Kitchen is going to come in and talk about going legit, how to transform your catering passion into a thriving business. So if you're not in the food industry, but you've got a friend, a colleague, or just the person who comes by the barber or the beauty salon that's always selling chicken salad and fruit, or the person who's got a mobile food truck, but they really want to get in a brick and mortar restaurant, or just friends who's always baking things for different activities, but would really like to go legit, this presentation is going to be for you. He's going to talk about all about how you get into a commercial kitchen. He's going to go over what ghost kitchens are. What are some different models for being able to promote your business outside of just a regular restaurant business? So you guys have got to come out and check out Cameron Burkhardt from Sugar Bee Kitchen. Again, you can come in person and get a free meal catered by Sugar Bee Kitchen. The doors are going to open at 5:30. That way you have time to check in, fix a plate, and have a seat. And then we started for 6 o'clock for everyone, whether you're in person or you're online. So if you can't make it, no problem. We know traffic is kind of crazy sometimes. Or if you're all the way across the country, you can join us online too. It will still end by 7:30. We are always respectful of people's time. We know you have other things to do. So that's on November 6th. But if you're not in the catering or food industry, don't worry. You have got to be online on Thursday, November 14th. This is for anyone. We're going to have Dr. Ram to come up and talk about silencing self-doubt. He's going to talk about empowering entrepreneurs to overcome imposter syndrome. If you don't know what imposter syndrome is, that's when you know what you're doing, but you don't feel like you're qualified. Are they going to know I don't know how to do this? Am I the right one? Do I know how to handle this? He's going to work with that. He's an amazing speaker. So please, please, please clear your calendars. Make sure you're registered Thursday, November 14th at 6 o'clock p.m. And then we're going to round off our 5th Entrepreneur Speaker Series, Franchising 101, the Blueprint to Success. We again are going to have 2 speakers to come out, and they're going to talk with you about, is franchising for you? If you want to get started, do you want to go make your own business model? Or do you want to buy one that's ready-made and then grow it from there? This pair of speakers, phenomenal. They have a pedigree that is out of this world. We're talking Wingstops, Subways, Massage Envies, athletic gyms, you name it. They've done it all. So they are the right people to talk about franchising 101. So don't just keep this information to yourself. You can scan that QR code. You can go back to the Dallas Entrepreneur Speaker Series collection on Eventbrite, or you can go to Linktree/Speaker Series. That is our evergreen link. It never changes. We always put all of our events there, as well as recordings and speaker info. So if you need to get in touch with Isaac or Kevin, this is how you do it. Now I have to point out that Linktree has a dot in the middle of the word tree. It is tr.ee. So it's www.linktree with the dot between the R and the E /speaker series. And you will see where you can register for all of our events, find out about past events, and just grow your business. But that's not all you can do. So again, after you sign up for Going Legit, transferring your catering passion into a thriving business, then we've still got more for you. No matter what your small business is, Dallas College does this for a reason, and we don't charge. The reason that we do this is because we want to help you succeed. So it was great for you to come and get some information, but sometimes you need somebody you can talk to have a one-on-one conversation that can give you personalized advice and optimize your business growth. So Dallas College has already funded an opportunity for you to have a virtual one-on-one experience for you to develop your business model, to help you reach your financial goals, and kind of to understand the story your revenue is telling you. So if you have questions about growing your business, you can scan this barcode, or you can still go to Linktree/Speaker Series. And you can also click the link and it will take you right here to what we call our DCBC Growth Lab, where you can grow your business. So that being said, I know we told you a lot of things today. If you remember nothing else, remember Linktree with the dot between the R and the E /Speaker Series, because that will get you to everything you need. So I want to thank you again for paying attention. For those of you who were able to join us from the beginning, thanks for being on time. For those of you who showed up afterwards, thank you for still coming. We are excited to have you join us, and we hope that this will not be your last time. We will continue to do this because this is all about you. So if there are any other questions, I'll stay on the line for just a couple more seconds. If anybody needs anything, I'm going to turn the recording off just so you can come off mute. If not, you guys have a wonderful evening, and you will get some follow-up communications with the notes and the slides. Thanks again. Thank you to our speakers for coming out tonight. You guys have a wonderful evening. I'm gonna ask our speakers to stay on for just a couple of minutes. I'm gonna stay on for a couple of minutes. For the rest of you guys, go out and enjoy the rest of your night. Bye-bye.